market catalysts. I'm Julie Hyman. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Intel shares are plunging as its outlook disappoints. We'll bring you the analyst take on Wall Street and whether the dip is a buying opportunity. Plus, we go live to the NASDAQ to speak to the CEO of Equipment Share as that company goes public. And we'll bring you the biggest takeaways from President Trump's trip to Davos. All that and more coming up on Market Catalyst. Let's get a check on the major averages right now. We are seeing a little bit of a mixed picture going on today. Right now, the Dow is off by 240 points. The S&P 500 down just fractionally, but the NASDAQ is up about 0.1%. If you look at what's been going on for the week here for the various major averages, actually, I'm going to look at a 4-day since it was a holiday shortened week. We got a down week for the NASDAQ. We got a down week for the S&P 500, and we got a down week for the Dow. And indeed, if you look at the year to date thus far, stocks have been higher, but kind of muddling along here in this middle section after the little bit of an increase to start the year. So we continue to watch what's going on there. Elsewhere, as we look at what's happening on the NASDAQ 100 in particular, Nvidia is not down 11% today, so I'm gonna move on. I'm gonna tell you about consumer sentiment, actually, which was just out in the past few moments here. University of Michigan final January consumer sentiment rising to 56.4. The estimate was 54, and one-year inflation expectations are at 4%. The preliminary number there was 4.2%, so a little bit of an improvement there in those sentiment figures. Let's move on to Intel, which is falling on a disappointing first quarter outlook as it deals with supply chain issues. CEO Lip-Bu Tan saying, quote, "We're working aggressively to grow supply to meet strong customer demand." Joining me now, Cody Acree, Benchmark Company Managing Director, Senior and Semiconductor Research Analyst, and Matt Bryson, Wedbush Securities Managing Director of Equity Research for Hardware. Guys, thanks for being here. So we see these Intel shares pulling back today. As we look at that reaction, I'm curious what you think was revealed that was new in these numbers that is accounting for that disappointment, given that we've gotten some guidance around what Intel was expecting. Cody, I'll start with you.
It really was just the disappointment in their supply availability. They really realized the strength of demand of the server side much too late in 25 to start wafers earlier. They didn't start them until Q3 and Q4, so that availability of new product won't be available for them until the end of Q1, which accounts for their disappointment for the first quarter's outlook. But I do think that sets the trough for the year, and then as supply improves, they are able to better meet that demand as the year progresses.
Matt, what do you think here? Because, you know, in the October call, Intel had sort of signaled this. Was it just that, but the stock has been running up, obviously, into these numbers. So what do you think around the messaging versus the stock action here?
Yeah, I think that it wasn't a messaging problem. I think rather that investors had gotten really hopeful that you start to see 18A ramp and there would be some pretty immediate benefits in terms of revenues and gross margins, particularly given a backdrop where, again, you're seeing constraints, you're seeing pricing rise. Those things typically lead to, higher gross margins, not historic lows. And so I think the stock just got ahead of where management's message was.
Now, guys, obviously the supply chain is an issue, but I guess the question is, should they have managed for it better? Now, your peer over at Bernstein, Stacy Rasgon, seems to think so. He wrote in a note in reaction to the numbers, he says, yes, the server cycle seems real, but the company appears to have woefully misjudged it with their capacity footprint caught massively off guard. Cody, do you think that Intel should have done a better job?
I think they should have. I think that's a fair argument that they said that their customers misforecast their own unit volumes heavily through the second half, and that accounted for their shortfall. But given the strength that we've seen through AI throughout 25 and what we've heard from NVIDIA and AMD, I think that the messaging was clear that demand was going to be strong. Intel was basically estimating based on their customer outlooks, and that at least accounts for the shortfall. But I think they could have managed it better.
What do you think, Matt? And do you have confidence that they are going to address this and manage it better going forward?
There was a step function change in August, September that no one saw. So you missed it on the memory side, you missed it on the compute side. So I don't blame them per se for not understanding where demand was going to be. I think that the struggle on my end is simply how do we model all their new products, their new processes, and it's not clear to me what the change from here is, for instance, in terms of gross margins and how they return to historic levels of profitability, and that's the difficult piece for me.
Cody, by the same token, you are actually a little bit more optimistic on the stock, at least judging by your price target increase there. So what's your reasoning behind that?
Julie, I think it's a matter of the rate of change from here, that once you set a trough for Q1, that as they accelerate through the rest of the year and availability improves, that they get the benefit of their first shipments of 18A and the volumes and the pricing benefit, the margin benefit that new advanced process will hit their model as the year progresses. I expect they also, as the year goes on, they also are able to finally talk about new customers for their 14A program, and that will be the big catalyst for the stock, is if they can finally set a base for an ongoing foundry business.
I mean, all of this said, Cody, the stock run up, I mean, I guess you could argue some of it is optimism in what you're talking about, but a lot of it also had to do with, the president saying he met with Lip-Bu-Tan, the sort of external investment from SoftBank and others in Intel. And so when you look at the valuation here, given that it was sort of puffed up by some of those elements, how do you strip that out from where it should be valued here?
I think that there is that there's been a lot of hype and over exaggeration of maybe the momentum in the short term that obviously accelerated the stock. But I think in the long run, Intel is very well positioned to become a domestic alternative to TSMC and to be a real foundry alternative to an industry that's quite frankly extremely capacity constrained and in need of an Intel alternative. AMD has been killing Intel on market share. If Intel's new process is able to improve its competitiveness, then it may be able to stabilize its market share. And I think all of that, along with the domestic investments that we've seen from the government, from NVIDIA, from SoftBank, are all signals that are showing some improved confidence of Intel's competitiveness going forward.
Cody, I'm curious about the memory chip. I know you don't cover memory chip makers specifically. Matt, we're going to get to you on that in a second. But I am curious about the ripple effects for Intel. And we talked about this earlier today with our reporter Laura Bratton. The idea being that if memory is in such short supply that, for example, PC makers won't be able to make as many because of that could then affect the Intel chips that go into those devices as well. Are you worried about that at all?
Yeah, and Intel communicated that as much last night, saying that higher memory prices and limited availability would likely limit their ability to fully capitalize on demand for the PC market, and that unit volumes would be impacted by rising prices at the consumer level. And so I'm not expecting the client side of their business to do much this year. I expect the server demand to be what really bails them out of this doldrums from the first quarter.
And Matt, you do cover some of the memory makers. I want to ask you about SanDisk in particular. That company's reporting soon. The stock is the best performer in the S&P this year, at least coming into today's session. But it does have very high short interest. I was looking at some data from S3 Partners that showed maybe some of this upside has been a short squeeze. You're a bull on the stock. So what's the fundamental case here for something like SanDisk?
I think the fundamental case, Julie, is that, again, you go back to middle of 2025 and memory vendors just had no idea this demand was going to show up with the memory industry. The problem is always that too much supply comes on and you end up with overcapacity. But because no one was anticipating this shift in demand, there simply isn't clean room space. So to build a new facility it's a 2-year, 3-year process. Half of the industry also supports DRAM, and they're focused first on getting enough DRAM out there, so not building NAND capacity. And so it just looks like we've got a multi-year positive cycle for the NAND vendors, which we haven't seen historically.
And if it is that multi-year cycle, whether you're looking at SanDisk or a Micron or some of the other, Western Digital, for example, that it had such a big year last year, so that implies you think that that can still keep going this year.
Yes, I think there's limited possibility that we get demand meeting or supply meeting demand this year. I mean, the one lone exception being some huge unforeseen demand shock, but from a supply perspective, you have the same problem in hard drives that you do in NAND, which is to build a new fab. In this case, for hard drive heads, it's a 2 to 3 year process.
We'll keep watching those stocks. Thanks, guys. Cody, Matt, appreciate it.
Thank you.
Coming up, we'll speak with the CEO and co-founder of EquipmentShare as that company awaits its first trade on the NASDAQ. We'll have more on the IPO next on Market Catalysts. EquipmentShare, which rents and sells equipment and technology to the construction industry, has raised $747 million in its initial public offering. The company is now eyeing a valuation above $6 billion as we await its first trade. Jabik Schlacks is the co-founder and CEO of EquipmentShare. He's joining us now, along with our own Brooke De Palma at the NASDAQ. Jabik, thank you so much for joining us. Talk to me about why you guys decided to go public. I mean, there are certainly a lot of construction firms that remain private and family held, as yours is. So what do you have your eye on through this IPO?
So I think the IPO for us is the beginning of another beginning. We started about a decade ago, and with about 5 of us. We did about $1 million worth of revenue. And today we did about $4.5 billion of revenue, and we have about 8,000 team members. But the scope of the problem in construction, and just for scale, construction is an $11 trillion industry, and people, materials, machines. The technology we've built fundamentally changes how job sites run, and we do think the public markets with a opportunity this big are the best place to do that.
Jabik, you want to expand your business from about 340 locations to about 700 locations. What are the challenges in your way to do that? And what's your message to investors here? How do you plan to do that now moving forward?
Yeah, absolutely. We're expanding from the 350 to 700 by 2030. And about 20 billion of OEC. And if you think of the growth we've done since 2015, growing from that about $1 million a year to the $4.5 billion, that is really that phase of growth has set us up to really transform the industry. And the scale, the scope of the problem, as we discussed before, necessitates a company like us doing it. But it is done very methodically. It's done by that customer pull-through. And we use an organic growth plan, which is a little bit different from the peer group, but it gives us a unique advantage as we scale.
How much of your demand right now is because of data center construction?
So great question. Data centers are a tailwind. It's not a huge portion of our business. If you think of, again, construction, you have trillions and trillions being spent, and that gap in productivity is what we're solving. Data centers and the tailwind of AI is absolutely a tailwind. And that's not only the data centers themselves, it is the power that's needed to generate. If we think of what we did in the US over the last year, the expansion we need, just from a power standpoint, does necessitate more productive job sites. And that's really why we're here today.
Jabik, you do have that physical footprint of the business where you're renting, you're selling equipment here, but you also have this cloud-based platform. What do we need to know about that portion of your business, and how fast is that growing as these construction workers, business owners, look to get on board with this wave of AI?
What's fascinating in our industry is because of the archaic nature of construction, if we compare it to other industries, even something like farming is about 10 times more efficient than it was in the 1940s. So from the 40s to today, a farmer gets 10 times more done. We look at construction, and we've basically flatlined as an industry since the 40s. And really, that's what we're solving. When you add that connectivity, that gap that we're missing in construction cost our industry about $1 to $2 trillion every single year. So we are solving that as an industry, and that is changing how job sites get done. And that's a fundamental difference when you're basing at the foundation of technology and connecting an industry.
And Javik, I'm curious, probably the best known public company to investors in this space is United Rentals. And so I'm curious how you all are differentiated from them. Is it that technology piece, or what do investors need to know on that front?
Yeah, there's a lot of really great companies. As we discussed, this is a $11 trillion industry every single year. And there's a lot of companies solving problems. I think really to that question, the DNA of Equipment Share, how we solve those problems, starting at that data level, that data, that transparency, is really the core difference. And then that enables a unique way for us to grow organically. Instead of buying that growth, you can grow organically. So it is a fundamentally different model, but you have to have the technology layer to unlock the value and grow organically.
Javik, really quickly, just want to ask, with all this tariff negotiation still ongoing, I've been speaking to so many executives where the costs are higher, and also in addition to that, it's changing the way that their consumers, their audience, their buyers are shopping. One, how have tariffs impacted your business here over the past year? And two, has that changed the way that your consumers, are they renting more? Are they buying less?
Yeah, I think that's a really, really good point. When you have tariffs, when you have economic uncertainty, when you're running a business, our customers, they go to value. They need to do jobs more efficiently. They need to understand what's happening on the job site. And that's where that T3 technology unlocks such a value for our customers that they're able to extract more value for their clients, bring more value, run safer job sites, run more efficient job sites. And they are in business to make money, so they can make more profit. And we think of tariffs, when there's uncertainty in the market, you tend to buy less stuff. And really, our business model, we already have the machines. We have about 8.5 to 9 billion of OEC, and that allows you to power these job sites without having to deal with the uncertainty of tariffs and supply chains.
Javik, thanks so much. And Brooke, thanks as well. Appreciate it. Coming up, severe winter weather is sending natural gas prices soaring, although we've seen some volatility since then. We're going to dive into it next on Market Catalysts. Natural gas prices have been rising this week ahead of severe winter weather expected across the U.S. this weekend. Yahoo Finance's Jake Conley joins me now with a closer look. The prices have been volatile. They are higher right now. So talk to me about this price action. I mean, because it gets cold in winter. This tends to happen. But this is a big storm that we're looking at.
Right. This is a big storm coming in, expected to be a huge cold snap kind of across the entire U.S., really from kind of the Mississippi line all the way to the eastern seaboard, Dallas to New York, whole country, right? Which is going to make people panicky and want to buy into natural gas because that demand spikes. Natural gas fuels most of the heating in the U.S. So when people crank up their heaters, natural gas futures are going to go up. But you're right. As of Thursday morning, the past 5 days were up around 75%. That's come down now to about 16%. When you see that kind of move, fundamentals steady, forecast hasn't changed, storage hasn't changed, but there's a big drop after a steep jump.
Yeah.
A lot of that's going to be traders unwinding their positions, taking profits, right? But you still see a lot of fundamental strength for natural gas prices right now as we go into the storm.
I mean, it's always tough in any market to separate out what's the fundamentals, what's the speculative pricing action on top of that. Is there any way of sussing that out in natural gas?
It's really hard. I mean, right now, if you look at EIA data, storage levels are actually slightly above the 5-year average for this week. So there is a bit of a cushion, but natural gas tends to be really volatile because you really can only move it around the country efficiently by pipeline. Pipelines are capacity constrained. They also tend to be nearly fully subscribed during the winter. So if there's a huge glut of demand, there's not much extra capacity to fulfill that demand, prices spike. But forecasts are always a bit of a hazy art, right, Julie?
Yeah.
So a lot of traders are going to be saying, how much do I trust the forecast? Is it time to unwind? A few analysts I've been talking to pointed out, the storm's kind of priced in. So for prices to go a lot higher again, you're going to need new information. Maybe the tail end of the cold extends further out into February, something like that for trader momentum to pick back up. However, would say that doesn't mean that there's not still going to be a lot of strength in those prices.
I'm curious also, like obviously if you're a nat gas trader, this is relevant, but what if I'm just an electricity buyer, right? Are there implications for these short-term moves, or is this something that power companies lock in advance, they hedge against, et cetera?
So it's always hard to say what the impact is going to be at the ratepayer level. But to your point, a lot of utility companies will go ahead and pre-lock in long-term contracts for natural gas during the winter. They know this demand's coming, and so they go ahead and subscribe to some of that delivery so they can get ahead of it. At the same time, this is also why pipelines end up being constrained during the winter, because that subscription is already there. Whether it bleeds into your heating bill, my heating bill, is really going to depend, I think, on the tail of the weather and just how long this lasts and how risky the market deems this. If there's more freezing rain, you could see a longer impact. Snow is a dry precipitation, right? It will melt off pipes. Freezing rain coalesces in the system, it starts freezing on the pipes, and that can actually impact that equipment more than a dry snow.
I know that we're talking natural gas, but I happen to know that you are also focused on the grid. And so that's also going to be really interesting during this storm, right? How is the Texas grid going to perform, for example? And then there's all this talk about PJM, which is the largest electrical grid in the US, like not sort of being in great shape.
Right.
So will this be a good test maybe for these grids?
I think so for some of that.
Not a good test if it doesn't pass, but.
Right, I think so though. PJM's been under a lot of criticism lately just for not really being prepared for the extra demand that's coming. The second layer here is the boom in data centers. A lot of those data center developers want power right now. Connection queues to get onto the grid are years long, so they're turning toward natural gas, which is going to take more demand. But if you look at the grid in Texas, which is pretty isolated,
right.
The last time we had major winter storms in Texas, you saw severe power outages, right? Huge downages for a long time. So this is going to be another test of, were they able to build in resiliency? And for PJM, I think a lot of that staff is going to be saying, what systems have we been able to put in place and where are there still lacks? And you're going to see state governors really watching that. Virginia, Pennsylvania, Maryland, all these states that are in the PJM service area that have been really critical are going to be saying, are you prepared for this kind of weather that's going to probably get more common to serve my constituents with electricity, how they need it, when they need it, or is there a lack that we're going to need to figure out?
Right. Well, fingers crossed for us and our grid resiliency and stability at this time. Jake, thanks a lot. Appreciate it. Coming up, Elon Musk making his debut at Davos. We've got the biggest takeaways next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching shares of Caterpillar, e.l.f. Beauty, and Starbucks. First up, Caterpillar. Barclays raised its price target on the equipment maker from $555 to $610. Keep in mind, though, the average 12-month price target on the street right now is even higher, though, at $642. The analyst at Barclays said it believes demand could increase in 2026 with 15-year replacement, suggesting a year-over-year increase in sales. Plus, mining truck sales have increased year-over-year for the past 2 quarters after declines in 2024. And keep an eye on this one because Caterpillar is set to report earnings before market open on Thursday, January 29th. Next up, e.l.f. Beauty. Citi initiated coverage on the company with a buy rating. The analyst said he sees a strong growth runway for the brand with consistent share gains at the legacy e.l.f. brand and strong distribution opportunities for the recently acquired Rhode brand. That's by Hailey Bieber. The analyst added that with the recent roughly 30% stock pullback following its second quarter results, it's now an attractive entry point. There are 12 buys, 5 holds, and no sells on the street for e.l.f. Beauty. Last up, let's take a look at Starbucks because William Blair upgraded the stock to outperform. It expects expects the company to post same-store sales gains in the December quarter for the first time in 2 years, which it believes will set it up well to return to full-year positive gains in 2026. And as sales recover, the analyst believes that will lead to a margin recovery within a few quarters. Wall Street's somewhat mixed on Starbucks. There are 21 buy ratings, 13 holds, and 6 sell ratings on the street right now. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Tesla CEO Elon Musk took the stage at Davos for the first time after years of publicly ridiculing the event, using his time there with BlackRock CEO Larry Fink to tout the future of robotics and self-driving vehicles. Yahoo Finance's Josh Lipton spoke to Ross Gerber, Kawasaki Wealth and Investment Management CEO, about Tesla's plans.
Ross, always good to see you. So let's talk Musk. Let's talk robo-taxis. Different headlines, Ross. My colleague Praz was just talking about this, that the company started robo-taxi rides with no safety monitor present in the cars in Austin. And then you heard Musk there at Davos, Ross, who was saying Tesla robo-taxis will be widespread in the U.S. by the end of this year. What do you make of it, Ross?
Every goal from Elon is by the end of the year. Every year he has a bunch of goals that are by the end of the year that never happen. So I don't think that really matters. I think the proof is in the pudding, which is you can go outside right here in Santa Monica right now and take Waymos left and right. They're everywhere. They're very successful. Robo-taxi is solved, and it's solved by Waymo, and they're scaling rapidly. This idea that Tesla is going to be able to rapidly scale robo-taxi on hardware for cars, I think has not been proven. And until it is proven, it's a level 2 system. Now, I just got the new software uploaded onto my car. It's 14.223 now, so I haven't tried it yet, but I'm still having issues with the software, and I still think it's not done, and I don't think it's solved at Tesla.
Let me ask you, Ross, kind of broad. Listen, you're an investor, longtime tech investor, so I'm just curious, more broadly, just beyond just Tesla, when you think about the economics of a robo-taxi market, Ross, like not near term, not medium term, let's think long term. What does that look like to you? What do you think growth and margins for such an industry could look like?
You know, I spent a ton of time thinking about this because of Tesla and because of Google, which is now my largest investment in my fund GK, and also for my firm, that's not true, NVIDIA is still larger, but in my fund, Google is our top pick right now, and you know, because they've solved so many of these issues. So longer term, what does this look like? Well, it looks like an ad platform to me, because it only costs about $1 a mile or less to buy a Tesla and just drive it around. So until the cost is below $1 a mile, which right now it's about 3 times that cost to use a robo-taxi, you know, it's still expensive to ride share relative to owning your own car. So first, that has to be solved. Once that's solved and the cost comes down, then you get into this race to the bottom because you have no barriers to entry. You have lots of competitors that have NVIDIA-based systems that will all be equipped in the next 5 years. And so the real question is, how can you generate revenue with a robo-taxi when you're not making much money on fares? And so that's advertising, and that's where Google is also in the lead. You'll probably be watching YouTube in the car. There'll be ads on the car or in the car, but in the future, there'll have to be other revenue sources driving the profit margins of robo-taxi. So I see this as a highly competitive, difficult business, and one, you know, that I think is already kind of being mastered by, you have the old player in Uber and you have the new player in Waymo.
So we talked robo-taxis. I want your thoughts on robots as well, Ross, because Musk was making news there too, talking about how robots could eventually outnumber humans. Let's talk about that robot revolution, Ross. I mean, do you think, okay, yes, long term, that is technology that could upend, redefine verticals, you know, households, factories, everything in between?
No, I think there's a limit to where robots will be, and I think that limit does run into the household versus working in, you know, factories where robotics is already being rapidly deployed, not only from Amazon but so many other companies. So robotics, there might be tons of robots in the future, but they're not going to look like humans. They're going to look like the issues they're trying to solve. Like my kid's tennis robot that hits him balls does not look like a human swinging a racket, and so it's a very good, effective training training tool. My kid just bought this robot thing for tennis, and it's great, but it doesn't look like a human. And humans have lots of limitations, as I've learned playing tennis, by hurting my foot. And so your feet are very, very difficult to make. And so this idea that we're going to have robots walking around like humans and handling things with our hands and having the brains and even the memory chips to even have brains, anything like a human, to perform stupid tasks like folding, it just doesn't make a lot of sense. That vision I don't see. So I see robotics being a major, major theme for investors moving forward from an industrial perspective, but not from a consumer.
Another headline I want to run by you, Ross. The headlines were dropping fast and furious today. Your timing is impeccable as always. Report saying SpaceX, Ross, you saw this, lining up bankers for a potential IPO. In terms of timing, they're saying could be this year, valuing SpaceX at around $800 billion. What do you make of that news?
Well, we've been hearing a lot of this already, and I think it's great news if you work at SpaceX, and we work with lots of people at SpaceX, so we couldn't be more excited at our firm for our clients and hopefully our future SpaceX clients, because if you work at SpaceX, we're here to help, and we have lots of clients there because it's a local company here. So we're very excited for SpaceX and what they've accomplished, and the valuation doesn't make sense, but that's not my problem per se, and nor would I personally be buying the IPO at $800 billion. But I think there's value in SpaceX, and it's a wonderful company. It's just what that value will be determined by the market eventually when it goes public. But I think most of the private companies today are vastly overvalued.
With Musk, though, Ross, is there key man risk at SpaceX in the way we talk about with Tesla?
I think it's different because SpaceX are really run by Gwen Shotwell. So the people at SpaceX are supremely, competent people with or without Elon. Elon, of course, is a huge asset to the company. But I think the reality is SpaceX performs pretty well without him. Unlike Tesla, which certainly has fallen behind in the last year because of Elon's not working at Tesla and working in the government. And he seems to be really focused at XAI right now, which is, doing a lot. So Tesla's kind of like the third thing on the list right now, still, despite a $1 trillion pay package and everything else. But he's having a lot of success in certain areas of his business, and he has a lot of challenges in certain areas of his business. So it's typical Elon. He's got a lot of moving parts, and some of it's doing pretty well, and SpaceX would be on that side of the coin, and some of it's not, and that's where Tesla is.
Ross, always good to see you, my friend. Thank you.
Yeah, thanks for having me.
Coming up as Davos winds down, the biggest takeaways from the conference next. The World Economic Forum in Davos winds down today. The conference was dominated by headlines from President Trump, who used the conference as a platform to advocate for the U.S. controlling Greenland. As the president returns to the U.S., for more on what the top economic issues to watch from the administration are, let's bring in Ed Mills, Raymond James Managing Director. Ed, it's good to see you. So as we sort of consider all of the hubbub over the course of the week in Davos, I am prompted to ask whether really anything is fundamentally different now than it was at the beginning. I mean, we knew that Trump wanted Greenland. That doesn't, I'm curious what you think has changed.
Yeah, Julie, I think what was really interesting and where I got the most questions here at Raymond James was there was an expectation that the speech by President Trump was going to be very domestic focused about affordability, a lot of details about housing, about credit cards, maybe about energy. And the vast majority of it was about geopolitical risk. I do have a lot of questions about how much of this is about near-term priorities, how much of it was potentially a diversion. There is a carrier group going to the Middle East. Iran still is very much high on the list. So coming out of this, we are going to see where this flows. President Trump is in Iowa next week. Are we going to come back to those domestic issues, or are those geopolitical issues going to remain front and center for investors throughout 2026?
I talked to a peer of yours earlier in the week, right after the speech. You said that maybe the speech was a bit of a dud from that perspective, that there wasn't anything new on the sort of domestic policy front.
Yeah, so I was getting a flood of inbound client calls here at Raymond James about what exactly was going to be there for housing. How much was this going to be about expanding supply, lowering mortgage rates? Were we going to have an announcement that you can use your retirement funds as a first-time homebuyer to possibly get that? What was going to happen with restrictions on single-family rentals? Last week, a lot of the client questions were on credit cards. Were we going to see a push again for that 10% cap? Were we going to shut down some of the fees that credit card companies and networks charge? We saw that in the speech, but that was on the back end of the speech. I don't think that's over just yet, Julie, but I do think it is second to the geopolitical issues. I do think that the breakthrough this week was about the fact that we started off with a tariff threat against a number of European countries. That has been removed. Greenland, there is a structure of a potential deal with the NATO Secretary General. I don't think that really fundamentally removes the Greenland question from a lot of investor minds. But really what the concern was is we were probably at consensus that we were at or near the top for tariff rates. But if we were starting to renegotiate some of these tariff deals, were we biased higher? I think that's where investors really didn't like that on Monday and where we saw the sell-off. But when we got the removal of those February 1st and maybe June 1st escalation of tariffs against European countries, that's where we saw the market rally. And the relief from that is that kind of extreme position only to pull back, kind of practice that President Trump uses quite frequently back. Probably.
Yeah, I mean, it feels like it's all just sort of continuation, right? We're still watching the credit card thing. We're still watching the housing thing. We're still watching him use tariffs in this way, right? So on a geopolitical front, we also had Mark Carney, of course, of Canada, talking about this global rupture and that other nations sort of need to acknowledge that things have sort of fundamentally changed. But that being said, does that mean that countries are going to change their approaches to the United States? And are there economic and trade implications from that?
Yeah, Julie, I would argue they already have. I think it was really striking that Carney was willing to continue this view. This is not the first time he's highlighted these issues, but it was really kind of important for him to do this after President Trump's speech, where President Trump really called out Carney, called out Canada, really challenged them. Last week, we had Canada sign a deal with China related to more agricultural purchases for the ability to drop the restrictions on EVs coming into China, going from 100% tariff down to a 10% tariff. Trump responded with, that's exactly what they should do. But we really do need to watch closely. Are we moving away from what has been a very good trading relationship here in North America between the United States, Canada, and Mexico to a more bifurcated trading relationship? That would have a much bigger economic impact than anything that we're talking about related to Greenland.
Ed, I'm really struck here because I'm seeing headlines as we're talking that silver is making a new high above $100 a troy ounce. Gold, as we know, has broken out. And there's really this interesting disconnect between equity markets, which have largely held up okay, and commodities markets, which are seeing a lot of inflows, which would seem to say that people are concerned about the things you're talking about.
Yeah, they are. And what I would highlight there, Julie, is not necessarily some of the retail purchases of this, but really what are central banks doing? And I do think this is probably one of those risks that we need to pay attention to. Here at Raymond James, we're starting to get questions. If a central bank starts buying more gold, and maybe not the same level of purchases of U.S. Treasuries, is that going to be a flare-up? Are we going to see tariff threats from that? Are we going to have to relitigate some of those issues? Secretary Bessent had gone after a report that there was another investment bank out there saying that should probably be that rebalancing out there. If that rebalancing starts happening, expect for all of these trade fights to reemerge in a way that I don't think this market is thinking about just yet, Julie.
That is a fascinating thing to certainly pay attention to, Ed, and we will. Thanks a lot. Appreciate it.
Thank you.
As I mentioned, we are watching those silver prices push above $100 a troy ounce. That's the first time that we have seen it at that level, and that's as gold prices have also pushed higher. Now, we were just speaking with Ed Mills of Raymond James about the sort of geopolitical catalyst that may have pushed it there and concerns over the diminishing value of U.S. Treasuries, potentially the U.S. dollar, maybe pushing some folks into some of those hard assets. So that trade does seem to be continuing here, and some investors questioning going forward whether we'll start to see, as Ed just talked about, the potential for central banks around the globe, which have already been increasing their buying of gold. Will they do it further? And on the flip side, will they decrease their buying of treasuries at the same time? So something very important to watch here in the year ahead as we watch these metals prices, precious metals prices, making new high. Silver, $100 an ounce. That does it for Market Catalyst. We've got much more ahead.